people know Bridgewater. They know Ray Dalio now. They don't know you quite as well.
Yeah.
So are you the yang to Ray's yin? How would you describe yourself?
I'd say a little bit. Yeah. I mean, I'd say we're great partners. I was, fortunate enough to join up with Ray 31 years ago. The company had just moved out of Ray's living room. And I think when I went up to talk about the job, I helped them load, they had just moved into this office, and I helped them load books onto the library bookshelves. I mean, so we've been together since the beginning. But I would also add Greg Jensen. The three of us really are the team, and then we work with a great team of researchers behind us.
What are the biggest differences, would you say, between you and Ray in terms of personality, but also in the way that you look at things and what you specialize in at Bridgewater?
There's probably more in sync than more difference, really. An essential part of how we approach things is that we have to really come to agreement about how the world works, how markets work, and how to translate that into an investment strategy.
Mm-hmm.
And so systemizing that. And so I'd say there's probably more in common, particularly from a value standpoint, from a culture standpoint.
Mm-hmm. But he does certain things, and you must do other things.
Ray is very big picture.
Mm-hmm.
He's probably the best among the three of us at the very big picture. I would say I'm probably would be stronger at the kind of translation of that into portfolio strategy, client strategy, how clients take that information, how we build that up.
So let's pick up on that thought, because yesterday when Ray was here, we talked about where we are in the cycle, and I presume you and he are in sync, as it were, on the idea that we're heading toward a point. Now things are great, Goldilocks, perfect, if you will, but heading toward a point where central banks are going to feel inclined to start raising interest rates at a faster pace. If that's the case, and if I've expressed it accurately, what is the right portfolio strategy and positioning?
Well, I think the thing to understand is that all assets have environmental biases. In other words, for every asset, there's a good environment for that asset and a bad environment for that asset. And we've been in a certain type of environment that's been kind of across the board really good for equities. And we're transitioning into that mid-cycle environment into what we refer to as a late cycle. And in the early stages of the late cycle, you have growth, but you don't have that much tightening of monetary policy. Still tends to be good for equities, but also becomes much better for commodities, for example, and bad for bonds. And then as you transition deeper into that and you face capacity constraints, you get more tight monetary policies, and then ultimately that's bad for stocks, bad for bonds, and then you just want to sort of hold on.
So if it's good for stocks at the moment, and for the foreseeable future, and if it's good, possibly even better for commodities, what does that look like? How much room does the equity market, the American equity market, say, or the global commodity market have to run at this point?
Well, it's ironic. Everybody's talking about how strong the economy is right now, which is true. But the stronger the economy is, the less room there is to run. In other words, the Goldilocks environment is particularly good for equities because it delays the tightening of monetary policy. The end really comes when the tightening of monetary policy withdraws all that liquidity and that relative to what's being priced in. And so too much growth is actually a bad thing because it creates a much more acute trade-off between that pickup in growth and the tightening of monetary policy.
Is that what you think is going to happen?
Probably this year pretty strong, and probably more tightening, more rise in interest rates than what's priced in, but probably not enough to offset the benefit of the improved earnings. And so in the near term, it's good for stocks relative to bonds. But transitioning, where people are really underweight is in real assets, commodities and other real assets. Financial assets have done so well for so long that people have just forgotten about that.
So I'll get there in 1 second, but the question everyone asks, can we have another 25% year in the stock market?
Probably not. Last year was an important transition year. We went from all-out monetary stimulation to central banks contemplating tightening but not actually doing it, but the growth picking up. And so the stock market had a free run where you had the growth and you had the earnings, but you didn't have the rise in interest rates. Going forward, there'll be a tighter, more acute trade-off between the growth and the earnings and then the rise in interest rates. And so as you increase the discount rate on those cash flows, it's going to be a drag on equities, but still probably net favorable, but less so.
People are talking more and more about real assets like commodities because they've begun to see prices move. Not enough in your opinion.
That's not a good reason, but
well, but that's how people behave, right?
Yeah,
they look at
that's right.
They look at historical returns, even if they're short-term, and
Yeah.
they say, "I want some of that." Right? The momentum investors,
well,
whether they like it or not.
Mostly, what's happened there is that because prices fell, keep in mind, commodity prices are about the only prices that are down, right? Because prices fell, it hurt the economics of investment. And so you had a reduction of capacity investment, and at the same time as demand has picked up. And so that's really reversed those supply-demand dynamics.
Bridgewater is active in just about every market for financial assets in the world. Are you at the point yet where you're thinking about crypto? And what I mean by that is probably Bitcoin futures as opposed to the actual cryptocurrency?
No. I mean, it's something to understand in terms of, is it having an effect on macroeconomic conditions? Is it affecting other things? I think it's the shiny object, you know. I don't go chase the shiny object, you know. Look at cash flows. Look at what you're paying for cash flows, you know. We want to stick to that sort of thing.
So long as it has no cash flows, it's not an asset?
Let's call it investing, right?